So I'd like to introduce my panelists. We have 5 panelists from all different sides of the industry. So the basic format of our fireside panel is we are going to be open to questions from the audience throughout the discussion. Our panelists are essentially going to quote unquote self-moderate unless I need to interject. I don't think I need to. These guys are professionals. We practiced a few times. And so this is really just going to be a conversation. If you have any questions, if you've ever had any questions regarding private equity currently, if you want to start your own business, if you're in business for yourself, please feel free to ask our panelists the things.
Most interesting, I think I'm going to hand the microphone over to the guy I think that we want to hear from the most. I think we all want to hear from him.
One, two.
Hi. All right, so I asked one of my colleagues about, and they all said, is the dinner free? It's not a really exciting time to talk about it in some ways, right? It's a challenging capital market, capital is tight, but that's also creating the opportunities at the same time, right? But the key to all of this is you gotta have dry powder, and you have to be at the table to win, or at least to play the game. So we're 6 years into an energy downturn. The story doesn't look that great when Dan Pickering comes and gives his talks. It's not a very uplifting message in that we don't see prices going up in the next couple of years, and beyond that, who knows?
One, two, one, two.
The cycle is working. Right? Capital starvation is having the intended effects. Asset values are coming down. You're starting to see things actually trade. Right? 2 years ago, everybody thought their reserves were worth PV8. All the buyers thought they were worth PV20. Now you're seeing them trade at PV15 or something like that. Right? And geology and geography are both very important. So if you're in the Permian and you're in Midland County, you have a pretty healthy market actually, probably as healthy as it's ever been. You want to go buy peons gas? Great, right? It's free. Or whatever, right? East Texas stripper wells. That market effectively doesn't exist. And so where we've started to see a lot of opportunity recently has been in the passive upstream space. So overrides, non-op, minerals, those markets have been wide open and pretty attractively priced, especially at the lower end of the middle market, so kind of under $100 million transactions, especially, again, outside the Permian. Those are really trading for PV 15, 20, 25, because there's just no liquidity. There's no market at that size. Other places where we're starting to see a lot of interesting opportunities are moving towards the operated side, but there's all this private equity capital. It's sitting there on the sidelines. The bar is really high, but they're very protective of their positions. There's a lot of egos at the portfolio companies, and there's a lot of dry powder at private equity funds that allows these companies to sit on positions that potentially they overpaid for, but not be forced to sell them. I will pause there, hand it over.
Are you seeing any changes in the structure of the investments due to the funds maybe lengthening their lifespan in order to accommodate with cyclical changes? Because I can tell, and you know this, but 4 years, is great when it's 180 90. 4 years is not great when you're kind of where we are. And I can tell you in private practice and doing private equity, we would see all the buys, and then we're involved in all the sells, you know, on the sell side. And it's within that horizon, that ultimate horizon of that fund and that investment that's over, you know, the portfolio company's investments. So do you see an expansion of that time? And I think that kind of also may go to an overall shift that I know Clark can talk to with respect to growth and value.
Yeah, absolutely. So one of the guys I first started working for always used to say that you knew there were private equity guys in the room because we would walk in backwards because we were always looking for the exit. It's true. The fun part is that right now there is no exit, right? Public markets are dead. If you have a great minerals portfolio that's worth $1 billion, you can definitely take that public. Effectively, any other energy companies are not going public right now. And 5 years ago, you used to have to be in the right zip code, and then you just had to be in the corner lot. And now you actually have to go and build the house and run the Airbnb and develop the corner lot and actually be capitalized to see that all the way through. So I think we're seeing sponsors, for sure the sponsors understand that the game has changed. You can't just come in, pay your $25,000 an acre and flip it with your one monster well in the corner. That game is over. So sponsors are definitely taking that into account on new investments. The question is, what happens to all the legacy investments of these billions and billions of dollars that have been wiped? My guess is we'll see a ton of consolidation come into, particularly the Permian, right? And Cap doesn't need, I don't know how many to have 15 management teams all running around with the CEO and CFO and everybody else. I think you'll see a lot of consolidation there. Definitely much longer time frames, time horizons. You see the LP community willing to take a much tighter range of returns for a lower risk. That's definitely a trend that we've seen. So investors will take mid-teens returns all day when your downside is you get your money back, as opposed to swinging for the fences at 30-40% rate of return, where your downside is a goose egg. So we've definitely seen that. And then the other thing that we've seen is, in addition to timeframes getting longer, investors have been able to, I say this, I think it's true, I think we're finally seeing it now, continue to move risk to their side of the table piece by piece. I think we saw a period where there was no covenants, very, very covenant-light debt coming in. The banks, I think, for now the third time in the past 10 years or so, seem to be getting a little bit of market therapy, and so banks are tightening their lending restrictions or their lending covenants, and you're seeing it on equity and on debt. Terms are just getting slightly better for the investors in terms of covenants, in terms of rates, controls, just the terms that you're starting to see. So I think we're starting to see, in addition to time frames getting extended, you're seeing the texture of the deals change. It's not necessarily the quality of the deals are the same, it's just sort of the terms are getting increasingly better for those that have capital, because the whole industry needs capital, and only the best projects, in theory, get funded.
I think you hit it on the head, Chris. It's not so much that the game has changed, because everyone agrees the game has changed. I think the bigger problem we're seeing is that nobody's know what the new game is. It's a little de-risking. It's moving to minerals. It is, rather than getting a $200 million commitment, you need $1 billion to play. You know, there's no more prove and drill your way out of trouble. Those days are gone. And so now everyone is sitting there going, what's next? What is the next play? Where am I? Because you're right, private equity is sitting on a ton of dry powder. They've got a ton of cash sitting there. I think we got the stupid money, as I like to call it, out of the equation. They realize that if they don't speak Texan, it's probably not a good idea to come down here and buy oil and gas assets. If you can't spell oil, then you probably shouldn't be here. But at the end of the day, it really is, what is the new game in town? And no one's figured it out yet. Everyone's trying different things, but your assets still aren't moving around much. We're not seeing the transaction levels. And there's gonna be a lot of assets coming on the market here pretty damn quick. Between the pending restructurings, as I like to say politely, in other words, bankruptcies, that are gonna be coming down the pike here probably within the next 12 months. That, you've got some of these mega deals that are happening that they're gonna have to shed assets also. I believe Occidental Anadarko has to shed $15 billion worth of assets sometime in the next 12 months. So there's gonna be a lot of stuff out there, but no one knows how to play the game right now, because for the first time in our industry, there's not the idea if I throw more money at it, the profits will come. I think everybody has not done that anymore.
This would be a question for, I don't know if this is working. Turn on. All right, thank you. Maybe to Chris and the other panelists, but going back to the walking into room backwards and exit strategies and the going public route you already addressed, just not really there right now. What about the consolidation that you touched upon and the mergers? Do you, any opinions or observations that you think that's going to be various portfolio companies being merged together and at least creating a bigger asset size? And then is yours Pickering or others, do you think relegated to the fact they may have to own some of these companies for 10 years, even if their fund had a 7-year initial life? Or do you think the publics will come in and buy anything? Because the publics, if you've seen, have not been rewarded at all for even merger of equals or even buying private assets at very, very attractive multiples. So any thoughts on what you're seeing and where you think how the consolidation may occur?
Go ahead. So Dave Wishon on Darcy Partners. I think, and so at Darcy, our clients are both the public E&P operators, private equity funds, and portcos. So I mean, that's certainly happening. You've seen a press release that's happened to our clients. I think what kind of goes into this period of uncertainty around what the new game is, the one thing that hasn't changed in the last 6 months really is we're hearing from both the financial sponsor level and then the private E&P level is, I need to figure out how to operate these assets very efficiently, because regardless, I'm not going to keep getting capital infusions just waiting for the buyer, right? So I think you're absolutely right that all of these, the traditional game of punch a hole in the ground and flip it, that's done. I mean, we have clients today who we called on them 2 years ago and they laughed us out of the room saying, I'm not going to operate this asset. Why would I ever need a production surface technology, right? Who came back and said, hey, you know what, actually, maybe we could use some sensors and flow meters. So that's more anecdotal, but I think another trend we've seen from our clients at the sponsor level is them taking a hard look at who within those portcos really is operating efficiently. And I think those teams potentially end up, historically, they kind of smash together. Whoever had the better management terms in the contract would end up operating assets. But we're seeing a lot more inbounds from the sponsors to really do kind of to understand out there at the field level who's executing and who's not.
And consolidation is also consolidation from what we're seeing it's consolidation along the life cycle to production. So it's kind of trying to get rid of your middleman along the way, get rid of your marketer, and do the marketing yourself. You know, have the operator do the marketing, or gathering. You know, the gathering assets and the pipeline assets are becoming important. The most interesting things that I'm hearing about, and I haven't seen yet, and I'd be really interested to see how it works, is consolidation mergers amongst portfolio companies. Seeing, I mean, it's been a very competitive, past 15 years between management teams and private equity in terms of establishing those relationships. But there's a lot of talk of I guess it's expect the unexpected, because if it makes sense from a value, and that's really what it is, how can these companies diversify? When private equity is talking about energy, it's talking about diversifying their money. These companies have to think in terms of, well, how do I diversify? I drill and I find, oil and gas. And so they can diversify by doing a little bit more than what they would normally do, if they're not thinking, oh, I'm just going to flip these assets in 4 years. So honestly, I feel like that's a positive. I think anytime especially, look, I'm in a very large law firm, and yet I firmly believe in value over growth. But I'm just a little guy in Houston. But I think that's always a good sign and a good metric that you're on the right path in an industry, especially when there are other challenges that the industry is going to have for the next 10 and 20 years.
I think another thing to add is that if you just say trust is at the heart and soul of a lot of this, you can solve a lot of problems. If the banks and the investors feel like they trust the oil and gas operators to deliver efficiently year in and year out, then they're probably going to spend money. There's a lot of money on the sidelines, and what are they waiting for? A lot of times oil and gas companies, unfortunately, we haven't been very good recently at predicting our performance for our undeveloped cases. If we go back to when shale started, about 2009, 2010, prices were very, very good. It's almost like you could do no wrong, okay? And when you can do no wrong, everyone's making money, but you're not truly assessing how good or how bad you are. It's a nice way of saying you can screw up a lot at $100 oil. Well, now, years down the road, it's time to pay the piper. When we were completing horizontal wells, we were making all kinds of variable changes at the same time. We were changing our well spacing, our lateral length, our cluster spacing, our cluster size, our proppant and fluid. We were changing so many different things. And now all of a sudden, we have to actually be efficient with our capital. We don't know which variables and which knobs to pull right now to say, okay, I'm going to maximize my volume with as efficient amount of capital as possible. We can't physically do that. I've yet to see an operator actually say, oh, I've maintained my completion design for the past 3 or 4 years and I like it, I'm going to stick with it. Instead, I see operators every year changing their completion design because they're changing too many things at the same time. They can't pinpoint exactly what is causing the good and what is causing the bad. And unfortunately, that, I think, has caused us to overpredict a lot. Okay, and now that we're predicting, all these investors that have all this money on the sidelines, they don't trust us anymore. And so until we develop that trust back, that money's going to stay on the sidelines. So we're probably going to see a lot of majors potentially, being able to buy off other folks. Chevron was the one that kind of started the deal with Anadarko, and they missed out. So are they going to buy somebody this year? I don't know, it's quite possible. But to rule them out, I don't think is wise, they started that deal. So I do see some of that consolidation going on. But your longer standing operators are probably gonna have the best bet, mainly because they have the track record of doing that, you know, of delivering efficiently, delivering productivity year in, year out.
What you're describing is kind of a specialty in operations.
Who's speaking? Oh, there you are.
Yeah, sorry.
It's like,
Not that good. So my question is there a difference in those companies that are built to flip, you know, every 3 or 4 years versus an operating company? It's a different style of leadership. And does that mean, even though you may see consolidation, you may also see leadership changes? What do you think is going to happen, and does that then go to restructuring these deals to consolidate maybe a legal morass? How do you solve something like that, bringing in a whole new leadership team?
well, I think one of the things you're starting to see is in private equity, elimination of the management teams altogether. Where, why have 10 management teams who are operating different portfolio companies when I could just have one team that's on my payroll, and that creates greater value? I mean, it goes back to the growth versus value. If you're talking growth, you want all those management teams sitting there proving out those wells, but now if we're talking true value, I gotta operate them, well, maybe it's just one operating team, or maybe it's one set of leadership within the private equity firm operating all these assets. Because that eliminates a whole level of costs, lots of overhead. And so there is that direction, and I've seen it in some of the more successful PE funds that I've worked with are the ones that they're just doing everything in-house and not going to an outside management team.
Give a good example of a company?
Sarbona. They don't invest in management teams, they just buy assets and operate them out of their own portfolio. I get $10 from them just for saying that.
Highest return this year. So I think you're gonna see, you know, a fund like Quantum,
Yeah.
and I wish I could remember the number. It's something like, in the Permian, $250 million a year of G&A. Let's just say they could cut 100 million of that, and remember the days when upstream assets used to trade for 5 or 6 times? Just by laying off like a dozen CEOs, consolidating assets, without increasing production by a barrel, they could realize like $500-600 million of value uplift. That's potentially more than they could ever realize drilling a bunch of wells and raising billions of dollars of capital, right, and just actual value creation. So I think you're gonna see that happen. I think it's gonna be driven by the LPs.
Mhm.
I think the LPs will get sick of it after, you know, they're 7 years into some investment, and they're just like, all right, hey, NCAP, hey, Quantum, hey, whoever, you guys gotta figure this out and force it. It's the only way we can create value. I think you're gonna definitely see that. The game has for sure changed. I'm not sure there's much of a role for the land aggregation team anymore. It really is a develop, exploit, optimize situation. Great, you got the corner lot, good for you, but your sponsor or whoever it is gonna need to bring in the team that can then take it all the way through to through development. And then the way, to your question earlier, how do we react as GPs? Like for our firm, we'll never be an NCAP, right? We're never going to raise $2 billion. We'll go back 20 management teams, shoot 10 of them, and end up with our 10 portfolio companies. The way we adapted to this is we just had a first close. We launched a JV with Henry Resources in the Permian to be a buyer of PDPs. It's like, who's gonna, all right, so there's all this private equity money that's gonna go drill all these wells. Who buys it from them? And what we found was going to an LP and saying, hey, we're really smart guys. We've been working in energy for a long time. Give us money. We'll go build your portfolio. It didn't really resonate, but hey, we've got a world-class partner with long operating history, there's one layer of fees, we're gonna go prosecute assets in this geography for a very specific reason, these very specific asset types over the next 2 years. And if that window moves away from us, then that window moves away from us. But this is a yield vehicle, we may never sell these assets, we're just gonna buy them, hedge them, and blow them down. That worked, and it resonated. As opposed to, hey, you hate oil and gas, it's a horrible sector to invest in, trust us, we're really smart. That market is gone, right? Just the same way that drill a huge gusher and exit your company, if that market's gone. It's the same thing for the GPs. We've just had to adapt to define the risk profile, define the asset type. I'm like, hey, you're NCAP with 20 years of great returns in history. It's a different situation, but in today's world, the trust us doesn't work for the investors.
It's really a business that's really conducive to that, if you think about it. If you think in terms of the lifespan of the wells, and you think about some of these alternative investments and some of these renewable, plants, and it's really kind of ripe for this long-term hedge, this real long-term play. I don't want to minimize the difficulty in exploration and everything, but I think folks were, came really easily when prices were really, really high. It created, a certain skill set as well. But I think overall the industry, with a change in the model, is it's really attractive to private equity. If you would look at some of the how they invest their money in some of the projects that they do in other places, I think that you have to tackle some of the latest social changes that are going on. But once again, it's also another industry that I think is actually done once again, maybe it's because I live in Houston, but I think they've done a really good job in tackling some of those environmental, social, and governance issues historically. Go for it.
Yeah, but unfortunately, the tackle onto what you just said is we as an industry are very bad about tooting our own horn. We don't pat ourselves on the back and tell everybody, hey, I just planted 1,000 trees, or hey, I just, saved the whale, or cleaned some turtles. We don't talk about that at all. It's like we just hide in our corner because everybody else hates us. We're the oil and gas industry. We have a really bad problem of talking about sustainability to other sectors. And so if we had maybe a better image in terms of, the investors are constantly wanting to look at renewables and other opportunities. If we as an industry had the same type of positivity and image, they might be more willing to invest. But unfortunately, we don't do a good job of doing that. We've only just started to talk about sustainability. I know in SPE, we've only just started talking about our sustainability programs, and we have a new sustainability group now that focuses on that and does monthly meetings for that. But in the past, it's not something we've really talked about as an industry-wide effort to let the world know what we do in terms of sustainability and helping our environment, reducing our carbon footprint.
I think that's part of the problem. So Norway just opened up a field in the North Sea, Equinor. I'm still going to call them Statoil just because I'm old. And so they were announcing that the field and the production and the drilling was going to be 100% zero carbon emissions. It was all going to be powered by renewable energy, and so they were going to be able to produce all this oil and gas coming out of the North Sea with a carbon footprint of zero. And they were very proud of that. Because if you know Norway is has the smallest carbon footprint out there in Europe. And they're very proud of that. They're going to go to zero by 2025, I believe. as soon as they said that, the articles came out saying, yeah, but what about the oil you're pulling out of the ground? You're not including that in your zero carbon footprint. So even when they do announce they're doing something right, the industry still gets pounded on no matter what. And that's just the unfortunate. Because renewable is the big topic now. That's what everybody's talking about. There's lots of money going towards renewables. But if you really ask the people in the industry, they're 20 to 30 years away from actually making it a dominant energy player. It's going to be still on the fringes, and oil and gas is going to be the biggest player in town, across the world. So I'm good till I retire. That's really all I care about. No, I'm just kidding. I don't have to go learn about battery technology or anything else like that. And so you're hearing more and more about the investments going in there that probably used to come to our industry. But now it's flipping over to that side. And it's making it much more interesting out there. Because at the end of the day, they still yell and scream about environmental, about safety. But we're doing such a good job, where the message is getting lost.
So I've just got a quick question. You just talked about how renewables are about 20 to 30 years out.
Mhm.
You also mentioned that peons is kind of a no-go right now, which I don't disagree with. But we're also kind of starting to pull a lot of these smaller groups together into larger groups that are managed by one group. So do you all think that the future, the near-term future, let's say 10, 15 year out, is going to be in small companies learning how to do big company development and compete with the Chevrons and the Exxons in the Delaware Basin, or it's going to be go find the next basin?
I mean, I can say from my perspective, once you control for the sheer balance sheet differential, right? I mean, Chevron and Conoco, pick your major. I mean, they have a balance sheet that can support much larger scale, so inherently you're going to get better efficiencies. I wouldn't, from what we've seen, operational at a field level. So how do you design your completion? How do you execute this well? You know, how are you running casing bottom, right? What kind of tortuosity do you have in this wellbore? I wouldn't necessarily assume that the teams doing the best from a execution efficiently perspective in the field are the majors. So I think there's going to be winners, there's going to be losers. You're always going to have the majors. Another thing to keep in mind also is that the pendulum is starting to swing a little bit more back towards offshore. Right, so if you're a Chevron, if you're an Exxon, you saw this morning what they just announced. I mean, for the last 8-9 years, all of your capital, all of your engineering powerhouse, everything's been going unconventional in North America. Some of that's going to get pulled back offshore. So I think there's who knows what's going to happen in 5, 10, 15 years. But I think there's potentially a space for the emergence of very well executed, almost super privates, right, that are cash flow business. Doesn't necessarily need to be public, it can be, that's kind of besides the point, but yeah, where you roll up some of these assets that are very inefficiently being run, just given the overhead underneath, single teams.
I think I saw 5 rigs are coming into the Gulf in the next year. Was it 5 or 8? I mean, it was a number that I about fell off my chair when they said that, because that's how big the Gulf is coming, and it kind of makes sense. Can you guys hear me without a mic? The idea that now we're having to operate these assets, well, it's easier to operate 1 billion barrels than it is in one well than it is, I can't do the math, 1,000 wells at 1 million barrels. It's just much easier and much more efficient. You get efficiencies. It costs a heck of a lot more, but if you're going to spend that money anyway, you might as well do it in the most efficient way. Now Gulf of Mexico is turning into that. And we're starting to see it.
But it's your generation that you're talking about, you know? So I wouldn't discount the entrepreneurial aspect of the younger generation, you know, not wanting, there's always gonna be opportunities. And I'm a lawyer, so I have no idea what's gonna happen in 15 years. I barely know what's gonna happen in 3 months. But, you know, I mean, I still wouldn't discount, you know, the millennial generation for wanting to have something that's their own and smaller, even if the easier money is is gone. Yeah.
I think one thing that, maybe I'm too young to be this cynical, but I don't really think the investor community as a whole cares at all about any of the stuff that they talk about. Emissions, some stuff. I don't really think it matters. They've been able to get rid of oil and gas as a sector because the returns have been horrible. We sit in this room and it's really easy for us in our echo chamber to be like, well, if your options are services or midstream or upstream or non-op, I'm going to invest in this sector. I don't understand why investors wouldn't come to this space. Apple stock is up 80% this year, right? You know, any other sector, it's been up and to the right. So it's really easy for the investors to say, oh, we're going carbon neutral, we're getting rid of our entire oil and gas portfolio. Look at what great corporate citizens we're being. They don't really care. It's easy. They know personally they can't go to their investment committee and say, hey, I need another $1 billion to go invest in oil and gas private equity funds. They're looking out for themselves. Oh, and by the way, we get to put out a press release that says, look at what great corporate citizens we're being in 2020. We're not going to invest in any more oil and gas. Again, my opinion, oil goes to $100. University of California Regents is going to put $10 billion into oil and gas. And tell their constituents it's you know, not prudent to divest the sector if there are the returns to be made. And so what I think this will do, one thing I think that's interesting about my generation, the millennial generation, is we've approached energy as if it's a technology problem, right? Throw enough money at it, and Moore's Law will show that you'll get these exponential gains. Physics and chemistry have their own separate laws that don't allow things like renewable integration to happen as quickly as cell phone proliferation or apps or whatever else, right? These are physical problems. So again, my personal cynical opinion is, at some point, or if and when reality can't keep pace with idealistic viewpoints of politicians, you will see business as usual, and folks will just find other ways to comply. So in this case, it would be like, you're just going to buy carbon credits even if you're a natural gas power producer or you're JetBlue, who says they're going to go carbon neutral. They're still going to burn a ton of oil and gas. They're just going to buy carbon offsets and be carbon neutral. So I think there's going to be some piece of it where you actually see investment on whatever it is, right? Renewables, transition. By the way, emissions reduction has never been a goal of of climate policy or renewable policy in this country. So all we've done is build a bunch of capacity. We haven't actually done it with the intent of lowering emissions, which is neither here nor there. But I think you'll see those things happen in other ways. So you'll see people build renewables at some pace, whatever pace the grid can handle. And then you'll see folks plant trees in China and buy carbon offsets to comply with various other regulatory structures, which I believe will get more onerous. But it may not be the case where, hey, we have a 50% emissions reduction target and you get there by reaching 50% renewables. You'll do it just by buying offsets or some other scheme or construct, right, to make that happen.
Scheme, great word.
Yeah.
Councilman, I love that.
I think another point to make is that we talk about ESG and, there's a lot of press releases, and I also, probably too cynical for my age, but I think it's the 2 once-in-a-lifetime downturns before we hit 30 that probably did it. But when you think about what we're actually talking about, everyone throws out ESG and kind of visions of windmills and this and that, and what is the new battery tech? But really, the industry's been doing this for a while because that's just good business, right? I mean, most land rigs have had dual fuel capacity generators on them for 15 years, just because fuel gas is cheap. Oh, and by the way, it also burns cleaner, but at the end of the day, that's just good business, right? So I think the pragmatic side of all industries was like, yeah, of course we want to use less, produce fewer emissions because we have to pay for diesel, right? So you're definitely going to see a trend towards that, and I think it is technology. It's not really developing new technology; it's just deploying what's out there, right? Once there's an incentive that you can quantify, whether that's a regulatory framework or whatnot, then all of a sudden that's what looks like a superfluous spend to feel good. All of a sudden that makes a lot of sense because, now I can actually quantify that. And so, yeah, I'm gonna switch up, put a gas processing facility out in the Permian so I can clean up my field gas and run my frac fleets on it, right? Because there's some value there. So I think it's worth keeping an eye on that, taking a step back from the PR, the buzzwords, the ESG, this and that, is what I think about. At the end of the day, no one wants to pollute the environment, right? Never once met an oilman who says, you know what? Yeah, we're just pouring out oil. It's great, So I think there is room for it in these world of the future, and I also don't see a risk necessarily to oil and gas, because I do disagree somewhat that I don't think the capital that's flowing into alternatives would have flowed into oil and gas to begin with, just from a capital allocation standpoint, right?
David, are you seeing any technologies at Darcy Partners that you feel it will, help private equity companies become more efficient?
Yeah, absolutely. So I think the biggest trend that we've seen come from the sponsors directly is that they're now looking, because most of the private equity funds, the big ones have been around for a while, they're sitting on a tremendous amount of data, right, from all the different portcos that they've had over the years. And so we've seen a meaningful and notable uptick in requests for technologies around data aggregation and cleansing, right? So they're actually starting to look at the data that historically was maybe sitting on tape somewhere and stored in an Iron Mountain facility somewhere and saying, you know what, we ran seismic in this XYZ prospect 20 years ago and we said there was nothing there. Can we go back and look at that? And maybe there is something that's economic that we overlooked in the past. So I think you're seeing, really on the geoscience side, a lot of interesting technologies being deployed internally on the funds themselves versus just at the portco side.
You have to be somewhat cautious when you're dealing with some tech companies. A lot of the tech companies, that's what they want. They want the data. So they can have technology, maybe it's cloud-based or whatever, that they could put on the rig. They're going to analyze the data they're getting and then provide you with how to make it more efficient. But yet, at the end of the day, they will own the data as long as it's unidentifiable data. They will keep the data. They will aggregate all that data with all their other customers, it is something of tremendous value. And I've seen that in the renewable space with turbines and efficiency with respect to turbines. And there are a lot of companies out there that are starting to see how could I have this information, sell the information, trade on the information, et cetera. So you have to be cautious. The documents that you would have with your, because it's essentially a vendor that's providing some equipment and services. The old language doesn't really work. You may think it works, but really when you start looking at it, if you look at it from kind of a privacy or a data standpoint, it doesn't really work as well. It's not like dealing with an independent contractor where it's work for hire and you own everything. They're very savvy. In fact, they're fairly open and honest about what they're doing as well. They're telling you, we're going to provide you with efficiencies, but we're going to keep the data. It'll be unidentifiable. You say, oh, it's unidentifiable, that's okay.
Well,
But
let me hop in.
Sure.
I would agree that we're talking about data science, machine learning, training the algorithms,
Yeah.
right? And you can't, it's this fundamental idea of you can't unlearn what you've learned, right?
Mhm.
So you can't disassociate the algorithm today that was trained open source on other people's data,
Mhm.
right? But I think that's something that the industry needs to get comfortable with, because that's the only way you're going to gain efficiencies from these tools, right? Because if you think that you're going to go out, pick up a stock TensorFlow algo, open source, customize it, build it, train it, first of all, even the majors don't really have enough true data to actually train these models appropriately, and then get the efficiencies from it, that you're not going to see efficiencies at the end of the day. So I think, that's something sort of to be aware of, and I think you absolutely need to be conscious of the data ownership, but the being able to control the learnings of the data, I think is, it's probably, you're giving up some of your value potentially. I could see that argument, but frankly, unless you do, you're never going to get the efficiencies.
Question way back there.
Folks, wonderful presentation today. I have a rather high-level question for everyone on the panel. All of the assumptions of industry, of the press, of all of us in the room, we all know that private equity has been very unhappy and is very slowly and selectively rewarding companies, operators, ventures that are really throwing off cash flow and rewarding the stakeholders right now. All of that is predicated on the idea that we're going to have a certain amount of production going forward. 1 year, 3 years, 5, 17 and a half, whatever you want to count out. There's an awful lot of indication right now that the fall off in production is actually going to be very close to the typical decline curve of an unconventional well. That is, without the multiple billions, tens, hundreds of billions of dollars being thrown at unconventional that has just in the last 5 years brought us up to this huge peak of oil production. It's going to roll off nearly that fast. And nobody, other than our friends that are really out on the fringe, like Art Berman, dare I say the name of he, there's very few people that will disagree with the EIA and the IEA that we're going to have all this oil burn wash, and nobody's going to want this nasty, dirty oil and gas in 5 or 10 years out, and we're magically going to figure out how to do gigafactory batteries for a few $1 million. What happens if it all falls back and $60 becomes a floor? 85, 103 becomes a floor? I don't know. Guess any number, but the decline in production is going to be precipitous, just like you see on every unconventional decline curve. Nobody's going to notice it at first First year or two, they're gonna say, Sechrist, that idiot. But no, look at your decline curves, folks. Everybody that's slowed down, the drop in price, there are ducks out there that are no longer economic to drill. Now, when they get back up to $60 or $70, those ducks are gonna have value again, but how long is an open hole good for? Well, certainly 6 months to a year, but is it gonna be good 3 years? Is it good in all stages of rock? I've only thrown out a few hundred questions for you guys, so I want to take you back up to the high level. If it doesn't decline like everybody thinks, we don't get this nice, fat, slow decline that gives us all this wonderful, inexpensive, flat price in oil and gas, year or two out, 3 out, it's going to be interesting.
Two quick
I
points.
think.
2 quick points, if I can remember all of your questions. I think it'll take longer than you're anticipating, mainly because the moment you start to see a drop in prices, people are gonna go right back into the fold. You know, it's feast or famine in our industry, and in the moment they see prices start to go back up, they're gonna start drilling again. And so a lot of times you don't just see one big uptick and one big downtick, you see a lot of volatility. And so I think you're gonna see that more than anything else. So that's part one. And part two, there is a lot of inventory still there. Just because it's not proved does not mean that it's off the books. It's probably been downgraded, people are still sitting on it, and because no one's able to really sell it, it's still in their inventory. So the moment prices go up, it's back in, you know? And luckily with SEC regulations, they had to take it off because of the economics, but now they get to put it right back in, and they get to start the clock over. They get 5 more years to develop that well. So it's gonna take longer than I think everyone's expecting. Everyone just thinks this doom or gloom type of mentality is happening, and I don't see that. There's too much inventory there. And if companies aren't really selling off, then the inventory is gonna stay.
I also think you've had a situation where every company, private or public, puts in their investor presentations, their management presentations, whatever the case is, about these amazing returns at the wellhead, right? 60, 70%. Then you look at, this is easy to do in the public markets, return on equity is, like, if you're great, like 4%, right? This is our firm's whole thing, is that the industry destroys capital. And they've done an amazing job of destroying capital. Well, it goes back to 60, 70, $80. Money will show up whether or not the industry makes any money with that is, TBD. I think the industry historically has never really made money, right, because of the volatility in the commodity. It's been a low single-digit return on equity in the public markets. So I think the industry has a long way to go to prove or translate what these half-cycle, well-level economics actually mean in terms of making money. And then the other piece is that the markets can stay rational longer than you can stay solvent, or whatever the old saying is. I think one thing that's striking to me is it's been a long time incorrect bull on natural gas, and we've actually now just for the first time in years and years, we've seen that Marcellus production actually decline. And natural gas is trading $1.88, right? The market doesn't care. And so, all good points. I read Art's stuff, and he's probably right. He's got his opinion, and the decline curves are high, and you have to drill a ton of wells to keep the treadmill going. The market just doesn't care, and so as an investor, it's hard to put chips on the table and deploy capital into something that you may believe and the math may support, but with an unknowable catalyst to create the value. It's like, yeah, there certainly isn't enough oil and gas, or there certainly aren't enough reserves at $55 for what the market is pricing in today. But when does the market wake up? We're actually seeing natural gas production flat to declining, with demand going up into the right. It's January 27th and gas is trading above 90. So you can't make investment decisions today based on that, which makes it a really confusing market. And then I think it just means you have to get the best geography, the best rock, the best cost structure, and make sure you're under levered so that you can live and make money today in today's price environment, so that when that event happens, if and when it happens, you get enormous amounts of operating leverage, and all of that falls straight to the bottom line, as opposed to making a bet today for a future, for an uncertain future that may or may not materialize.
I mean, I keep looking at peak oil wasn't that long ago, right? For those of us old enough to remember, it was all, we're running out of oil, we're running out of oil. Technology is a way to solve that. And we always seem to find a way to find more oil. I mean, I can't believe to this day that we are the largest producer of oil in the world. You know, we blow everyone away.
Let's get a little blunt about this.
Okay?
We got this oil. Microphone, please. I'm an old guy now. I spent my career with Chevron and Gulf looking for conventional fields. Had some success, but not enough. Back in the days when we knew this shale, we started understanding the geochemistry and all this in the 70s and 80s, that it was full of oil. 500 billion barrels or a trillion barrels or whatever you want to call them. Trouble is, this new technology, I'm retired now, I love this $2 gas. Gasoline at the pump. But also, I don't know how you figure it out, but that's a bunch of your investors that's lost about 180 billion, maybe 200 billion, 250. I'll just be blunt. I don't think it's ever going to make money.
Yeah, no
But
question.
anyway.
Question back there?
We mentioned the steep decline on the unconventionals, and we kind of also alluded to capital being deployed offshore. Should private equity companies start being or allocating capital towards PDP heavy, low decline, oil-weighted assets, and is now the time for them to really be picking those up cheaply? And then kind of on the separate question, are there upcoming technologies, specifically kind of enhanced oil recovery techniques, that could really continue to deliver reserves, especially just in the future going forward?
So the answer to your first question is yes, unequivocally yes. The challenge there is that LPs and, despite working for one, GPs are like middle schoolers at the playground. So because like Pretty Kid is over in the Permian, that's the only place you can play right now. Like, I personally would love to go find low declining conventional East Texas assets, because you can probably buy them for like PV 40 today. If I took that to Dan Pickering, it'd be like a career limiting move, right? You can't do that, because then we'd have to go look our investors straight in the face and be like, oh, we're buying stripper wells in East Texas, but I thought the Permian was the only place you could drill right now. So the answer is yes, and if you have the right texture of capital, I think you can get there. It's just a really hard hill to climb. Being an oil and gas investor today is already challenging enough. To go do something that's really kind of, smart is challenging, but because we're so smart, that's why we just launched this PDP strategy, right? It was that was the exact pitch to the investors was, kind of to your second question, we don't need to find any more oil, right? We don't need to take recoveries from 12% to 15%. We'll just go drill a new well. There's plenty in Midland. We'll deal with that in 30 years when we drill through the inventory. We need to go secondary and tertiary recoveries. So it's moved certainly away from EOR technologies or exploration technologies, really to, saying earlier, you used to have to be in the right zip code, and now you just kind of then you have to be in the right neighborhood. Now it's like, what hardware are you putting on the drawers? And it's really in the details of how you're going to specifically develop the assets that you have. And so the devil's in the details, and it's moved a lot. The risk profile has shifted, which has shifted the return skew, right? If you were just like, hey, I think Midland County is the place to be, I'm gonna go put a bet down, that may be worth nothing, you should get a 3 to 5x on that. But now you have your Midland position, there's people drilling all around you, that risk profile's changed, so the return profile comes down with it, but the sponsor has to shift their mindset. Like, okay, this is a different risk profile as opposed to we're just gonna drill a well and get out. It's long-term asset ownership and stewardship. So it's a little bit different.
There was a dip in 2015. I mean, a lot of folks came to buy the dip.
Yeah.
You know, we're all dealing with it right now.
Yeah.
So that lesson, I mean, that is the ultimate lesson
Yeah.
of I think tonight and everything that's being said here, which is why the shift is to value. So, you know, there's a lot of money that's not here anymore that shouldn't have been here in the first place. I'm probably, let's not put that on the videotape, but on YouTube. I'll get in trouble for that one. But, you know, we're still seeing deals. We're seeing those deals that you're talking about. People that know what they're doing in the right places, and so.
Yeah, but even in that price dip, you know, on a production profile, United States production didn't actually go down, it just flattened. And then the moment prices started going back up, production ramped up. Okay, so to say that we're gonna see this massive decrease in production is not likely, okay? And to talk about your question earlier about what basin, you know, we're probably not gonna see another onshore basin in the United States that's huge to really have an impact. But Mexico just opened up a whole bunch of GOM blocks that hasn't even been talked about. I mean, I think Talos had a big discovery, but that was just the tip of the iceberg. Okay, so we have a whole bunch of stuff that's probably coming up, you know, and being discovered in the next few years to keep prices low.
Suriname, Guyana.
Yeah,
Yeah,
so, I
Guyana.
mean, prices are, like you said, they're not gonna be
I
high.
will offer one comment about reserves and amount to put yourself in reality. I think the BP data for 2018 showed that we were producing about 92 billion barrels, 92 million barrels a day out of all the world's wells. And then we were consuming about 100 million barrels a day, but you make it up with refining grains, grease from the kitchen, etc. That's 85 million barrels a day, which was Boone Pickens' favorite numbers, what, about 31 billion barrels a year. So you go start looking at all these areas, how much are they going to produce? I doubt.
The 67 Six-Day War, the 1968 gut, the 1978, 90. So, but the main thing is, in the past, the operators that we've seen that have been successful have diversified both geologically by area, they've diversified for gas and oil, and they've looked at opportunities that maybe didn't fit what the portfolio was at that time. What I'm seeing over and over, and you probably are too, and I just wanted some verification, a lot of these operators are consolidating in a specific area, in a basin, for example, Martin County, Howard County, Arion County, you know, Ward County, wherever they want to be. What happens when the GORs get to the point where they have to capture the venting gas? Or what happens when there's not enough pipeline capacity to move it to Cushing? You're seeing that in the Rockies for the gas that goes through Opal.
Yep.
It can't go west, there's no place for it to go, so the gas is falling through the floor. Do you see many of these companies that are specialized looking at opportunities in other areas so they can cushion the blow when it comes, and it will come, of being able to cover their overhead and take care of their shareholders? I guess that's the question I wonder about what's going on.
I think we've kind of seen that a lot. So,
Thank
I used to work for an integrated, you know, mid-major, or major independent, whichever way you want to call it. And they were very diversified. They were not and now they are very concentrated. You know, and so I think it's the investors and the investment market that's kind of really dictating that the diversification is gone. That you really need to focus in on what you're good at or the area that you're good at, so that you can really truly industrialize the operations, because that's where we are. We're at the industrial side.
Yeah.
We're Ford Motor Company back with the Model T, just put the oil out, drill a hole, get the oil out, drill a hole, get the oil out. You know, the technological revolution associated with the last 10 years is that's where we're at. We invented shale, we know how to get it out now, so let's the production line run. Yeah, I agree, but it sounds good. And so, until the investment community changes their philosophy, that's gonna be the way it is. And it's gonna take time, you know, and you gotta take out the majors. The majors don't count. Everyone else, focused.
What's the best way to find funding for a lower middle market company?
What was the question?
Call him.
What's the best way to find funding for a lower middle market company?
Strip all the risk that you can manage out. And I know it's a little tongue in cheek, but it's hard enough raising capital in a fully baked oil and gas deal. Like Exxon has trouble accessing the capital markets right now, so how does Chris and David Corp go out and raise money? And the way
Really slick deck though.
yeah, really slick deck.
Good
Look at us, right? We're so charming.
Nice thing.
Take as much risk as you can off the table. One thing I think it's interesting about, to your question about kind of diversification, is the LPs don't want that, right? They don't want portfolio company A to have Bakken and Permian. They're invested in that company because you guys are my Midland County exposure, and I have my Delaware Basin portfolio company, and I have my Piceance company, and I don't want you doing that because I already have my exposure there. So it's kind of an interesting market right now where a portfolio company may see a really good opportunity in something they know how to do, but it's rail cars in Colorado, and this is a Permian Basin company, and they can't touch it, right? So they can't take advantage of the opportunity. So I think to both the questions, to raise capital, really targeted, very specific asset class, place in the capital structure with a defined time frame with very specific reasons for why you're going after. I really like this asset class in this region for these very specific reasons. Here's a bunch of experts who know these assets better than anybody else. Nobody cares about the utility infielder anymore, especially if they play for the Astros. Nowadays, it's like, I don't care that you can play all the positions. I want the person who knows Erie and County better than anybody else, and this is the person.
But that game has changed too. It used to be you could do that for 50, 100 million. It's $1 billion to play now.
It's a much bigger
It's
number.
$1 billion.
I
I haven't seen any major new big investments that haven't had a B at the end of it.
That's right. Yeah, you gotta make sure you also have to go into it. Back in the day, you used to probably be able to get $110 million, which allowed you to buy $100 million of land and drill one well.
Yeah.
Now you need $500 million because you gotta go drill the land and drill, or buy the land and drill 50 wells or whatever the number is. So then you can go get your RBL and then get your follow-on capital and do the other stuff. So you have to, the going into it piece. I think you also, more money is made today buying right as opposed to being in the right place.
Yeah.
You just gotta be really patient and go put in a zillion bids at 50 cents on the dollar and find the right seller.
The White House has speculated that another tax cut may occur this year. What are your thoughts on how that will impact energy investing?
As the tax guy here, there's no tax cuts coming. There's no tax cuts coming. It's an election year. There ain't nothing happening. Gas prices are gonna be at $2. There's not gonna be a tax cut, period.
No tax cut?
No tax cut. No tax cut.
Read your lips.
Read my lips.
Even if there was, it wouldn't.
It wouldn't
have any-
affect
it wouldn't have any-
We're going to have about 5 more minutes, so audience members, if you have any burning questions you want to ask, that you want to ask the panel, please feel free to do so. I know that we have a bunch of intelligent people in the room, and I know you all have questions. Some of you may be shy though.
Two questions and a point. The question is, water is a very big problem and maybe an asset. Is there any looking upon it as an asset rather than as a disaster?
Definitely
The
look at it.
second point is, I'd like to make, is that we operate with a license to operate from the public. And you have sort of blown it off, but there is a very large movement starting in the K through 12 to demonize carbon, and it's catching on. Thank you. I'm interested particularly in the water. Thanks.
Yeah, I guess I think one point on the K through 12 is the reason we're drilling shale in the US is because we have very terrible reservoirs, right? No one would choose to drill shale if you could drill a punch vertical well in the ground for 4,000 feet and produce 1,000 barrels. But shale is not exclusive to the US. And to your point, global demand is going up and to the right, and that demand is going to be met. So I think it's not a question of can we meet it, it's who's going to meet it and at what price point. So we can demonize oil and gas all we want if we're comfortable with $400 barrel.
You can need it all we want if we're comfortable sitting in the dark.
Yeah, exactly. Yeah, if we don't want plastics, if we don't, let's not talk about how we extract, rare earth metals.
We're being
but-
rational though. There's a lot of irrational out there.
That's true.
So I got a sophomore in high school who just got his driver's license. That takes a lot to demon out of the carbon right there. He loves $2 gallon gasoline because he has to pay for it. I don't pay for it. So that really changed his perspective very quickly.
Yeah, I have an 11-year-old who actually has a major grade exam tomorrow in science, and it's energy. And a part of it was the EIA 2030 forecast, which I remember thinking, well, they came out with this forecast in 2015, and it's you would think we would update it a little bit, being a 2020, but they haven't. It's not, honestly, it's not a terrifying study. And there are so many rebuttals to that study. BP has a good one, Shell has a good one. They actually go to 2050. We demonize so many things, with the kids. At some point, it's white noise, and I can tell you, my 11-year-old cares more about just getting the answers right, and he doesn't mind the fact that we have a truck and an SUV and a sports car.
What about labor? What about your expertise that you need out in these fields? Do we have sufficient labor and sufficient expertise out there to meet these demands that you need?
So there's something that's really interesting.
Repeat the question for the rest of us.
Labor, is there going to be sufficient labor to meet the demands of the industry? I could tell you, being a lawyer, that I saw something really interesting. I started practicing in 2000, and there was a gap in experienced oil and gas lawyers, and the gap was a tremendous gap. It was more than a decade. It was
Same with accountants.
Right,
tax
it was at
people,
least
everybody.
15 years. I don't know that we necessarily handled it really well. We're in services, so we are reactive. It was a great opportunity for a lot of really young people to get hands-on experience. And you could do whatever you wanted to do, and as much as you wanted to do. And I think I think we're going through that a little bit. There's also technology is playing a big part in the, in kind of the junior positions in the services industries, accounting and legal definitely. But we've always been able to manage that. If there's a job and
It pays well.
it pays well, and there aren't a lot of people that can do it, it'll pay more and more and more, and then we'll just throw bodies at it, and then we'll have too many at some point, and it's back where we are.
Back where we are, yep.
Real quick on the water question, I think I'm from Colorado, and whiskey's for drinking, water's for fighting. I think you start trying to. I have a lot of very strong opinions about water, so I'm going to try and tone these down. The idea of water being priced as a commodity tied to its value makes a ton of sense. I think politically it's probably a non-starter, right? I mean, you just start trying to mess with people's water rights and start thinking through the realities of pricing all of that, and then what it would do to food, and the fact that you're already subsidizing food markets. I think it's a real problem. It's an increasingly important issue, getting a lot more attention. How it all plays out is up in the question. One data point I think is really interesting is there's an investment bank called Green Tech Capital. They were recently acquired by Nomura, and they published league tables, right, who's doing all the deals. And they're purely alternatives, 21st century transition bank. The number one deal from the last one of these I saw was sometime from last summer. The largest deal was Mesquite Water, which is an oil field services company with wastewater disposal assets in the Permian. It was listed as sustainable infrastructure. That is oil field services. Saltwater disposal wells, but they've rebranded it as it's water, so it's sustainable, it's infrastructure, which means all these infrastructure funds can now come in and destroy that market too. And so it's for sure an asset. I think you're going to see it actually has a much larger investor class than just oil and gas. And today, cash flow doesn't matter to most investors. So that market's great and wide open. So you got water assets, you got kind of that sort of stuff is great because you can access much larger pools of capital, and it can fall into a different bucket with different valuation metrics.
I like that they can invest in that plus toll roads. I think there's a nice synergy there.
Oh, yeah.
Toll roads.
So I want to thank all my panelists and the HGS for putting on this panel. And then if you can all just kind of give me, your 60-second overview from your discipline regarding your thoughts on the state of private equity in oil and gas. Thank you.
Well, I think we'll do what we do. We weather through it, and usually when it gets to its worst, somebody's figured it out, and we turn around and we adapt. It's one of the great things about our industry. And thank you so much for having me. And I enjoyed meeting the panel, and we've spent a couple of phone calls talking with each other about the industry, and it was at least good to know that we are all saying the same thing and not, a little sanity check. So, thank you.
Yeah, a big thank you as well from my end on the engineering side. I know private equity, certainly there's a lot of just negativity and just lack of investment, but oil and gas is not going anywhere, okay? Not by a long shot. And to say that solar and wind are gonna take over oil and gas just kind of makes me laugh in the back of my head. And I'm like, do you know what a joule is? And do you know what a BTU is? Because solar and wind, they don't come close. Okay, so oil and gas, even though maybe the investment community is not really on board with us right now, we're not going anywhere. Look at the supply and demand curve on a global scale. Okay, and that easily just sets your mind at ease. Oil and gas is going to be around for a long time. It's going to be king for a long time. I know you said 20, 30 years. I'm going to add another 20, 30 years to that. I got to last for my career too. Okay. I'll let my kids figure it out. But thank you very much for having us.
I guess the biggest thing I have is like everyone said, oil and gas isn't going anywhere. We as an industry tend to figure it out at the end of the day, and we're gonna figure this out. But it is a change. I think this is the biggest change the actual industry's gone through. It's not drill, prove, sell, flip. It is now time to pay the piper. Those days are gone. It's gonna have to operate. We're gonna have to be like real companies, produce profits, all that good stuff. Take on the right level of debt, and actually run these things like real companies. And I think once we get that taken care of, I think it's gangbusters again. Thank you.
Yeah, thank you to everyone for listening to me prattle on about God knows what I was talking about. I'm just kidding. I think this is actually a very exciting time for private equity within oil and gas. I think if you look at the past 20, 30 years, so much money was created doing relatively similar things, right? It's, I'm gonna buy an asset, prove up the idea, flip it, and a lot of people made a lot of money, which meant a lot of potential opportunities were passed over because there wasn't an incentive to take that risk. So I think for those who have dry powder and have that time horizon to look out over the next 5, 10, 15, 20 years, it's a tremendous opportunity to come in and create value out of those overlooked assets.
I'd like to thank everybody as well. This has been great. I think from my perspective, also echo that we're excited. We like being investors in the space due to and in spite of the challenging market that we find ourselves in. We don't, though, ever see a return to the good old days, right? To give you one more boom, and I swear I won't mess this one up. We don't really see that happening, right? The Greta Thunberg conversation isn't going away. It's not going to get any quieter. It's our opinion that you're going to see increasingly onerous, aka costly regulation in one form or another, whether it's social licenses to operate or actual regulatory structures come into the sector. And it's going to be part of the cost of doing business. So you're going to have to deal with this, whether or not, I guess, regardless of prices. I think in some ways, going back to $80 or $100 is the worst thing that could happen to the industry, right? If oil goes to $100, I was talking about this with the panelists earlier, oil goes to $100, natural gas goes to $5, everybody in California is going to be like, see, this is why you can't rely on these dirty hydrocarbons, because not only are they a horrible fuel, but they're too volatile and expensive. So let's double down on renewables. So it may not necessarily be what we want. Probably isn't healthy for the industry after we've gone through this whole period of learning about capital discipline and how to live within your cash flows, so then all of a sudden have this huge price spike that allows us to then go borrow
Mess it up.
Go mess it up again. And all I want is one. I've only been in this industry a decade, and I wasn't
wasn't old enough to realize what we had for my first 2 years before it all came crumbling down. Yeah, it's gonna be fine. But again, because of all the messiness, that's why there is opportunity. The folks that are in it aren't leaving. The valuations are coming into where they need to be, and there's a lot of really great opportunities now. Just a matter of figuring out how to message that to the market, and I think the way to do that is control your risk. You don't have to swing for the fences today, and you gotta get cash back.
Okay, so thank you everybody.